Good morning, everyone. The week is starting off with a jolt as the market focuses on Russia's intervention in Ukraine. Risk aversion trends dominate, as of course you'd expect. Oil is the biggest gainer on fears about European energy sources. Remember that Russia is the world's largest energy exporter, if we include both oil and gas. The precious metals also gained, as did the safe haven yen and Swiss franc. The Canadian dollar was the biggest gainer among the G10 currencies, probably because of its oil exports. It's no surprise that the ruble was the biggest loser of the morning, falling by around 1.5% when we got in the morning. The Russian central bank unexpectedly raised its key interest rate 1.5 percentage points to 7%, the first move in 17 months, but that had really very little effect on the currency. It only strengthened a bit to around 36.4 from 36.6, which is nothing to get excited about when you realize that it was around 35.90 at the close on Friday. So it didn't even recover half the gap on that interest rate hike. The second theme in the market this morning was the slowdown in China. The February HSBC market manufacturing PMI for China and a similar gauge from the government both fell to their lowest point since around last June, confirming the slowdown in China. This adds to the uncertainty around the country following the renminbi's recent unusual fluctuations. The lower PMIs hit the Australian dollar and New Zealand dollar, which were the biggest losers among the G10 currencies. Now, I'd expect these dramatic events in the Ukraine to continue to dominate the market and risk aversion trades to dominate until there's some resolution to these events. That doesn't seem likely in the near future. Moreover, the combination of heightened risk aversion and a slowdown in China is a recipe for a stronger yen. So I think selling Aussie yen could be an appropriate way to play those two themes. Eurodollar is likely to move lower, in my view, as the events in Ukraine affect Europe much more than the US. During the European day today, we get the manufacturing PMIs for February from several countries of Europe, from the Eurozone as a whole, and from the UK and the US. The French, German, and Eurozone's final figures are the same as the initial estimates, as usual. The UK manufacturing PMI and US ISM index are expected to rise, which could support those currencies. Also for the UK, the Bank of England mortgage approvals for January are also expected to be higher, which would confirm the expansion in the housing sector of the UK and support the pound. Besides the ISM manufacturing index, the US personal income and personal spending for January are due out. They're supposed to be mixed, which is likely to be a wash for the dollar. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Gittler, Global Head of FX Strategy at IronFX Global, wishing you solid trading.